Have you ever felt like your paycheck just disappears on rent? For almost half of American renters, 49.7% to be exact, that's exactly what's happening. The dream of homeownership that our parents took for granted has morphed into something that feels impossible for our generation. In this documentary, we're pulling back the curtain on why housing costs have exploded 57.8% since 2019, while our paychecks have barely budged. Whether you're a frustrated renter, a hopeful first-time buyer, or someone trying to understand the housing crisis, this is the breakdown you've been waiting for. What forces are really driving this housing nightmare, and who's profiting while we struggle? Meet the families, 3 stories of housing heartbreak. This is Zoe and Tyler. Last month, they put in their 7th offer on a starter home, 20% above asking price. They lost to an all-cash investor who never even saw the property. Meet Zoe and Tyler, both 32, who've been saving for a home since they graduated college. They've done everything right. Paid down student loans, built emergency savings, and even sacrificed their daily coffee runs. Now, with a solid down payment saved up, they're trapped in an endless cycle of rejection notices and disappointment. "We thought we were prepared," Zoe explains, her voice cracking slightly as she scrolls through photos of yet another home they'll never own. "We have good jobs, decent credit scores, and we've saved like crazy. But every single time, we're outbid by investors or people paying all cash. Their rental apartment feels increasingly temporary. Bare walls they can't paint, furniture they haven't replaced because, what's the point when we're moving soon? Except soon has stretched into 3 years of searching." The breaking point came during a walkthrough of a modest 2-bedroom home. Standing in what could have been a nursery, Tyler squeezed Zoe's hand. "That's when it hit us," he says. "We're postponing our entire life plan. Having kids, putting down roots in a community. It all feels impossible now." Across town, another family faces a different kind of housing struggle. Maria and Carlos Martinez live with their 2 children, Sofia, 8, and Miguel, 5, in a 2-bedroom apartment in Phoenix. For years ago, their rent was $1,100 a month. Today, it's $1,850, a 68% increase, while their incomes have grown by just 12%. "Every time the lease renewal comes, I feel physically sick," Maria confesses. "We negotiated down from a $300 increase to $200 last year, but we're still drowning. The complex stopped maintaining the playground, the pool is often closed, and they've cut back on all services." The hardest part came when they had to tell Sofia she couldn't have the backyard she's been drawing in her school art projects. "She keeps asking when we can move to a real house like her friends have," Carlos says, staring at the floor. How do you explain to an 8-year-old that housing costs have completely outpaced what mom and dad earn? Maria opens her budget spreadsheet. After rent, healthcare premiums, groceries, and the kids' needs, there's literally nothing left to save for a down payment. It's like running on a treadmill that keeps getting faster. As our camera slowly pans across a quiet suburban neighborhood of aging homes, we meet a couple facing housing challenges from a different generational perspective. Barbara, 69, and William, 72. Johnson should be enjoying their golden years in their paid-off suburban 4-bedroom home. Instead, they're trapped in a house that no longer serves their needs, but that they can't afford to leave. "We bought this place in 1992 for $185,000, Barbara explains from her living room, where a stairlift was recently installed. "Now it's worth about $720,000, which sounds great until you realize we can't afford anything else even if we sell." William, who recently had hip replacement surgery, motions to the stairs. "Our bedroom is up there, but some days I sleep on the couch because climbing hurts too much. We've looked at single-story homes and condos, but they're either too expensive or would leave us without enough retirement savings." The Johnsons have watched their property taxes and insurance costs soar while living on fixed incomes. "Our children live across the country," Barbara says. "We'd love to downsize and use some equity to be closer to our grandkids, but the numbers just don't work. We're essentially trapped by our own home's value." William opens a spreadsheet showing their retirement calculations. "If we sell and buy something comparable but single level, we'd have to withdraw an extra $1,200 monthly from our retirement accounts. That means we'd run out of money by our mid-80s. These aren't isolated stories. A time-lapse visualization shows how dramatically housing costs have outpaced income growth for each family. Zoe and Tyler have seen home prices in their target neighborhood increase 41% in just 3 years, while their incomes rose. Only 8%. The Martinez family's rent-to-income ratio has gone from a manageable 25% to an overwhelming 42%. And the Johnsons have watched property taxes increase at 3 times the rate of their fixed retirement income. The psychological impacts ripple through every aspect of their lives. Research shows that housing insecurity correlates strongly with increased anxiety, depression, and relationship strain. One study found that couples experiencing repeated failed home purchase attempts reported relationship satisfaction levels comparable to those going through major life crises. For the Martinez children, the consequences may be even more lasting. Studies show that children who move frequently due to housing instability score lower on academic performance metrics and report higher levels of social isolation. Sophia's teacher has already noted changes in her classroom participation since the family began discussing potential moves to find more affordable housing. The housing crisis reshapes life trajectories. Zoe and Tyler have indefinitely postponed having children. The Martinez family has cut extracurricular activities that might have developed their children's talents. And the Johnsons face potential health complications from living in a home that no longer meets their physical needs. As we continue following these families throughout our documentary, we'll see how they navigate these challenges, the compromises, the creative solutions, and sometimes the heartbreaking sacrifices they're forced to make. The numbers don't lie. America's housing affordability collapse. In 1980, it took about 5 years for the average American to save for a down payment. Today, try 14 years if you don't eat or pay for anything else. When nearly half of Americans are struggling to afford housing, we're facing a mathematical disaster that's been brewing for decades. The housing crisis reflects cold, hard numbers that reveal just how broken our housing system has become. And trust me, these numbers are about to make you seriously question whether the American dream still exists for anyone without a trust fund. Let's get real about what affordability actually means. Financial experts consider spending more than 30% of your income on housing to be cost-burdened. And in 2023, a shocking 31.3% of American households crossed that threshold. That's nearly 1/3 of the entire country struggling with housing costs. For renters, the situation is even more grim, with 49.7% spending more than 30% of their income on housing. Think about what that means in real money terms. The median monthly cost of owning a home hit an estimated $3,000 in 2023. $3,000 every single month. That's like making a car payment on a brand new Tesla, except you're just trying to avoid homelessness. What's truly shocking is how dramatically the price-to-income ratio has shifted. Today, homes cost 5.6 times the median household income, the highest in recorded history. It's like trying to climb a mountain that doubled in height since your parents made the journey. The game has completely changed, and not in our favor. Millennials need nearly double the relative income their parents needed to afford a similar home. Imagine if suddenly groceries cost twice as much as they did for your parents, relative to income. We'd call that a national emergency. But somehow with housing, we're expected to just figure it out. Even more troubling is how the Housing Affordability Index for first-time buyers plummeted to 65.8 in 2024. This means the average first-time buyer doesn't have enough income to qualify for a mortgage on a median-priced home. When the index falls below 100, affordability is officially in crisis territory. At 65.8, we're deep in nightmare territory. This crisis has spread across the country like an economic cancer. Heat maps tracking cost-burdened households show that the crisis has metastasized from traditional coastal cities to previously affordable regions. Places that were once refuges for those seeking reasonable housing costs are experiencing their own affordability emergencies. Take California, where 40.6% of households spend more than 30% of their income on housing. That's 2 out of every 5 households struggling to make housing payments. But this pattern is repeating across the country in places that used to be affordable alternatives. Remember when people would say, just move somewhere cheaper? Well, those cheaper places are disappearing fast. The affordability crisis is now a national epidemic, not a coastal elite problem. When housing eats up such a massive portion of your income, everything else gets squeezed. That dream vacation? Postponed indefinitely. Saving for retirement? Good luck with that. Starting a family? Maybe in another decade. The ripple effects touch every aspect of American life, from family planning to career choices to mental health. The timing couldn't be worse. These affordability metrics are cratering just as Millennials, the largest generation, are hitting their prime home buying years. Unlike previous generations who could reasonably expect to buy a home in their late 20s or early 30s, today's young adults are facing a market that seems designed to keep them renting forever. Multiple factors have created this perfect storm. Rising construction costs, zoning restrictions, investor activity, stagnant wages, and insufficient housing supply have all combined to create the most challenging housing market in generations. The data reveals a system fundamentally out of balance. Housing prices have skyrocketed while wages have barely budged. The median home price has climbed at twice the rate of median income over the past decade. It's like someone pressed the accelerator on housing costs while simultaneously putting the brake on wages. This crisis exposes a troubling wealth gap in America. For existing homeowners, rapid appreciation has been a windfall, building equity and wealth. But for those still trying to get their foot in the door, it's created a nearly insurmountable barrier. Each passing year widens the gap between owners and non-owners. Geographic spread of the crisis has created a new kind of economic segregation. Entire cities are becoming inaccessible to middle and working-class families. Communities that once housed people of diverse economic backgrounds are transforming into enclaves for the wealthy, while those with less income are pushed farther from job centers, amenities, and opportunities. What happens to a society when an entire generation can't afford to buy homes? We're conducting a massive economic experiment in real time, and the early results don't look good. Family formation is delayed, birth rates decline, wealth inequality grows, and social mobility stalls. For many millennials, the traditional timeline of adulthood has been completely derailed by housing costs. The milestones their parents took for granted have become luxury goods accessible only to the privileged few or those lucky enough to receive family help. The housing affordability crisis is about the American dream itself. When home ownership becomes unattainable for a large segment of the population, we have to question whether our economy is working as it should. Housing has transformed from a basic need into a speculative asset class, with devastating consequences for ordinary Americans. The missing millions, America's housing supply crisis. Behind this fundamental restructuring lurks a shocking math problem that nobody's talking about. America is missing 3.8 million homes. That's not a typo. Imagine if every single person in Connecticut suddenly had nowhere to live. That's the scale of our national housing shortage. This massive deficit emerged gradually after the 2008 housing crash. While most people remember the foreclosures and financial chaos, another devastating legacy persists today. When the market collapsed, construction rates plummeted like a rock thrown off a cliff, dropping by more than 50%. That's like trying to feed a growing family with half your previous grocery budget. Meanwhile, our population kept growing, people formed new households, and young adults wanted independence. But the homes they needed weren't being built. When demand grows but supply gets cut in half, prices skyrocket. This represents a fundamental supply-demand imbalance that's been intensifying for over a decade. The problem goes deeper than just total numbers. It's about the types of homes being built. Experts call it the missing middle housing crisis, and it's like a puzzle with crucial pieces removed from the board. Take Oakwood Heights, a neighborhood I visited in Michigan. In the 1950s, it featured a mix of small apartment buildings, duplexes, and single-family homes on the same blocks. Young couples could rent apartments, then move to townhomes as they started families, and eventually buy single-family homes, all within the same community. Today, those apartment buildings and duplexes have been demolished. The neighborhood's housing ladder is missing its lower rungs, forcing residents to either overextend for single-family homes or move away entirely. This pattern repeats across America. Look around most cities, and you'll see either detached single-family homes growing more expensive by the minute, or massive apartment complexes. The middle ground, housing that historically provided affordable stepping stones for first-time buyers or downsizing seniors, has largely vanished. Much of this comes down to zoning laws that favor single-family homes. Approximately 70% of residential areas in major cities restrict or ban apartments. These regulations, many dating back decades, have become like handcuffs on housing development. They've made it illegal to build the very housing that could help solve our affordability crisis. In most American neighborhoods, it's against the law to build anything except the most expensive type of housing. Imagine regulations requiring only luxury SUVs be manufactured while banning affordable compact cars. That's essentially what we've done with housing. The construction labor shortage creates another barrier in our housing puzzle. The industry faces an aging workforce with retiring skilled tradespeople, plus immigration restrictions limiting new workers. Without enough electricians, plumbers, and framers, builders can't construct homes regardless of price incentives, like trying to build a house with half the necessary tools. I recently spoke with Eduardo, a builder in Arizona who's been in business for 25 years. He told me, "I've got permits for 200 homes, but I can only build about 70 this year because I can't find enough skilled workers. I'm turning away business every day, even though prices are the highest I've ever seen." Eduardo's situation reflects a nationwide reality. Builders everywhere struggle with labor shortages, rising material costs, regulatory burdens, and restrictive zoning that limits where and what they can build. You might wonder, if demand is high and prices are soaring, why aren't builders constructing more homes? It seems like the perfect business opportunity. The answer involves several key factors. The construction business climate has become incredibly challenging. Builders face regulatory hurdles, unpredictable material costs, and labor shortages that complicate project planning. Many smaller builders never recovered from the 2008 crash, leaving fewer companies with capacity for new projects. Additionally, zoning restrictions limit building potential regardless of demand. You can have willing builders, but when local regulations mandate certain homes per acre or require large minimum lot sizes, creating affordable housing becomes mathematically impossible, like trying to solve an equation with missing variables. Economic uncertainty has also made builders cautious. With fluctuating interest rates and recession concerns, many hesitate to take significant risks needed to dramatically increase production. Some industry leaders remain hopeful about regulatory improvements. As one executive put it, "We know how to build homes. We have the technology and expertise. What we need is a regulatory framework that allows us to build the kinds of homes people can actually afford in the places they want to live." The crisis varies regionally. While the national shortage totals about 3.8 million homes, some metropolitan areas face deficits of hundreds of thousands of units. California represents a significant portion of this shortage, with Los Angeles and San Francisco experiencing particularly severe deficits. The problem has spread beyond coastal regions. Cities like Austin, Denver, Nashville, and Boise, once affordable alternatives, have seen housing shortages intensify as relocations drive up prices in these destination markets. The painful irony: people move to escape high housing costs, but create new shortages in their destination cities. It's like everyone rushing to a new exit on a jammed highway, only to create another traffic jam at that exit. Wall Street's land grab: how investors changed the housing game. As those traffic jams of frustrated homebuyers get worse at their new affordable destinations, they're facing an unexpected opponent at the open houses. In Springfield, Missouri, nearly 1 in 5 homes sold in early 2024 went straight to investors who had zero intention of ever living in them. These patterns repeated across Kansas City and St. Louis, with investor purchases hitting 20.1% and 18.9% respectively. When families talk about being outbid on their dream homes, this is what they're up against. What's happening in today's housing market isn't just personal disappointment. It's a fundamental shift in who owns American homes and how they're bought and sold. The dream of homeownership has transformed from a community milestone into something resembling a high-stakes Wall Street trading floor, complete with algorithmic pricing and institutional capital competing against family savings accounts. Investors have grown from a small slice of the market into major players, reshaping entire neighborhoods, explaining why finding affordable housing feels impossible for so many Americans. The numbers tell a shocking story. Across the country, investors purchased 14.8% of all homes sold in early 2024, literally the highest percentage ever recorded. Nearly 1 in every 7 homes sold isn't going to a family planning birthday parties in the backyard or planting a garden. It's going into an investment portfolio. What's particularly interesting about this investor surge is who these investors actually are. When most people hear investors buying homes, they picture huge Wall Street firms or anonymous corporations, but the reality is more nuanced. Small investors, those owning 10 or fewer properties, actually make up 62.6% of all investor purchases in 2024. These are often local landlords who might own a handful of rental properties as their business or retirement strategy. Institutional investors remain significant players with evolving tactics since the 2008 housing crash. Companies like Blackstone's Invitation Homes initially bought foreclosed properties at rock-bottom prices. Today, their strategies target affordable starter homes in growing markets, exactly the properties first-time buyers desperately seek. The tech side of this investor shift is particularly concerning. Landlords increasingly use algorithmic pricing tools like RealPage to coordinate rent increases across markets. These sophisticated programs analyze competitors' pricing and recommend optimal rent levels, leading to situations where rents rise in lockstep across entire cities. The concentration of pricing power has raised serious concerns about potential antitrust violations. When algorithms essentially help landlords coordinate pricing, are we still operating in a truly competitive market? This matters because research from the Federal Reserve Bank of St. Louis shows these investor purchases directly impact affordability. When institutional investors buy up properties, they drive up the price-to-income ratio in those areas, making homeownership even more out of reach. And they're specifically focused on entry-level homes that are critical for first-time buyers. The geographic concentration makes this even more problematic. In states like Georgia, Nevada, and Arizona, investors accounted for over 30% of sales in some areas during 2021. When investor ownership becomes concentrated in specific neighborhoods, it fundamentally changes those communities. Rents rise faster, and homes available for owner occupancy become scarce. Mom-and-pop investors operate differently than the big institutional players. These small landlords, who typically own between 3 and 10 properties, are often local residents themselves who understand the communities they're investing in. While they're still profit-motivated, they tend to have more personalized management approaches compared to large corporations managing thousands of units through standardized systems. The institutional side of the market is where things get particularly concerning. Giant investment funds with billions to deploy scan markets for opportunities. These are pension funds, private equity firms, and other financial players looking for stable returns. When mortgage rates jumped and home sales slowed, investor activity dipped slightly in 2024 but remains well above pre-pandemic levels. In today's bidding wars, cash is king. Institutional buyers often make all-cash offers that are incredibly attractive to sellers. No financing contingencies, fast closings, and sometimes even waived inspections. For a family scraping together a down payment and needing mortgage approval, competing against these cash offers feels like bringing a squirt gun to a wildfire. The impact goes beyond just the purchase price. When investors control a significant percentage of homes in a neighborhood, they can essentially set the market rate for both sales and rentals. Small changes in their pricing algorithms can ripple through entire communities, affecting affordability for everyone. Families looking to buy their first home are competing against sophisticated investment strategies backed by massive capital. This investor activity creates a troubling feedback loop. As more homes become investor-owned rentals, fewer homes are available for purchase. This scarcity drives up prices, making homeownership less attainable, which forces more families to rent, which makes rental properties more profitable for investors, encouraging them to buy even more homes. It's a cycle that's increasingly difficult to break. The human cost of this transition is real. When neighborhoods shift toward investor ownership, the character of communities changes. Long-term residents who know their neighbors get replaced by transient renters with less investment in the community. The pride of ownership that drives home improvements and neighborhood engagement diminishes. Schools see higher turnover as renting families move more frequently. Unlike some housing market challenges that seem impossible to address, the investor issue actually has potential policy solutions. Some communities have experimented with limits on corporate ownership of single-family homes or requirements that investors hold properties for minimum periods before reselling. Others have tried targeted tax policies that make long-term ownership more attractive than quick flips. But the most effective approach might be addressing the fundamental supply shortage that makes investor purchases so profitable in the first place. When housing is scarce, investors can charge premium rents and count on zoning out affordability, how rules block new housing. That supply shortage isn't just happening by accident. It's literally written into law across America. Ever wonder why you don't see apartment buildings or even duplexes popping up in certain neighborhoods, no matter how desperate people are for housing? Those invisible lines drawn on city maps might be the biggest housing affordability villains you've never heard of. Behind those perfectly manicured lawns and matching single-family homes lies a regulatory system designed to keep housing scarce and expensive. Zoning laws in America have evolved dramatically since their inception. What began as reasonable separation of factories from homes in the early 20th century transformed after the Supreme Court's 1926 Euclid decision, which empowered cities to control development. This legal foundation eventually enabled cities to create highly specific rules about what housing types could exist, where, overwhelmingly favoring single-family homes on large lots, the most expensive and land-consuming option around.